Welcome to our first Academies webinar for the 2023-24 school year. We will aim to make these a regular feature when there are updates from the DFE or ESFA that needs communicating. In May, Landau Baker merged with BKL, a top 100 firm of accountants based in London. We are now part of a firm with 24 partners and over 200 staff. BKL were the first accountancy firm to be certified B Corporation, meaning we focus on sustainability and staff welfare as well as profit. I'm Jake Liu, one of the Academies and Education partners, and I manage a portfolio of over 50 Academy trusts, ranging from single Academy trusts to a 17-school multi-Academy trust. I've been advising Academies since 2014 and I'll be managing this webinar. Your speakers today are Carly Pincus, who heads up the Academies and Education at BKL. Carly oversees the efficient and supportive service we provide to all our education clients. Carly has also specialised in advising Academies since 2014. Tyler Jeffs is an education, charity and not-for-profit specialist. He is a trustee and chair of Ops and Finance for a 4-school MAP based in Twickenham, and he has a real passion for Academies. He adds value and technical expertise to his clients. In this seminar or webinar, we will be covering a number of sector updates, any updates to the Academy Trust Handbook, the Academy's Accounts Direction updates, and then we've got a small section at the end where we talk about how we can help you and add value. If there are any questions that you have during the webinar, please add them to the Q&A chat box within Teams, and we will aim to answer these at the end of the webinar. I'll now pass you over to Tyler and Carly.
Thanks, Jake. So on the first slide that we wanted to discuss regarding sector updates, you can see that the top point is about teachers' pay rise, which is of course a hot topic in the sector at the moment. And of course, as you all know, at the end of July, the teachers' pay rise was confirmed at 6.5%, but of course only 3% will be funded. Then you pose the question, how will that 3% be funded, and is there any room, or how will trusts be funding the remaining 3.5%? Of course, there's the Teachers Pay Additional Grant, or the TPAG, that's the first point, but does that actually cover the 3%? Of course, trusts were given their initial allocation covering September to March for the TPAG, so you must keep in mind that you must extrapolate that to get the full year. And then also added to that, you must keep in mind that the 16 to 19 funding, where relevant for trusts, the rate has gone up by £111 per pupil, so of course that needs to be taken into account as well. On the point of TPAG, of course, this was announced on the 13th of July, and the DFE stated that this funding was to support schools with the September 23 Teachers' Pay Awards. The funding will be split between mainstream schools, special schools and alternative provision, early years and 16 to 19 provisions. The part of the funding, or the additional funding, sorry, that goes to mainstream schools, special schools and alternative provisions is worth £483 million. That was in 23-24. In 24-25, this will increase to just under £828 million. And of course, this funding is on top of the NFF funding in both 23-24 and 24-25.
Now, this TPAG, or Teachers Pay Additional Grant, forms part of the additional £2 billion that was announced in November 2022, and as the government put it, to keep teachers teaching in a safe and warm environment.
The point really here is what makes up the rest of that £2 billion. So as I said, in 23-24, TPAG was just under £500 million. Then we look at MSAG, Mainstream Schools Additional Grants, which of course was announced in April 23. And there's of course more to come in 23-24 and then of course in 24-25. MSAG is £1.45 billion of the £2 billion that Tyler just referred to. And as I said, this is given to all mainstream schools as an additional grant. On a side point, of course, we're also looking at the support staff pay rise, but that hasn't yet been agreed upon, and we're hoping that's going to come out towards the end of this calendar year. On the slide, after MSAG, we then look at the reserves clawback for large surpluses, or the idea of holding on to too much money. This is a rumour that's been going around the sector for some time. When we go to presentations at the end of the year, after the audit's finished for our auditor clients, we are always asked, or usually asked, about whether there's going to be a clawback where the trust is holding, in inverted commas, too much money at the end of the year. I always say it's hearsay, but the ESFA did come out with its first threshold or percentage last year for the 21-22 academic year, that really trusts should not be holding more than 20% in reserves at the year end of their total annual revenue income. Of course, if there is a good reason for that, then we can discuss that, and I know Tyler's going to touch on that in a minute. But really, last year was the first time we saw from the ESFA that they were looking at about a benchmark of 20%. This year, they're now saying that the range should be between 5% to 20%. And again, it's the reserves at the end of the year of the total annual revenue income. Of course, trusts have now submitted their budget forecast return by the end of August this year, and therefore the return would have asked some automated questions of the trust where they do go beyond that threshold of 20%. So the trust really should have answered those questions already, and the ESFA should have had the majority of their answers back where the trusts are exceeding that threshold.
Now, there are always good reasons to be holding additional reserves, and that really depends on the trust. This is not a blanket percentage where if you are holding more than 20%, it's almost certain. As we said, this is definitely at the moment still a rumour. We have seen nothing concrete. Talk about concrete in a minute. Anyway, you know, there's plenty of reasons, such as you are going to be building a new building, or you know you're going to be taking on or implementing additional form classes, i.e. you're moving from a 2-form entry to a 3-form entry. You may be looking to hold significantly more surplus. And actually the best way to deal with that is to communicate it with the DFE in the best way that we have, and the main way that we have, and that's through the trustees report. It's really explaining in the trustees report why we're holding those reserves and the reasons we're doing that and what we're going to use them on, and actually ring fencing those in your trustees meetings to say, okay, these monies are for this new building, therefore we're holding them for that reason.
The key point there really is ring fencing, because you don't actually have to have a formal commitment in place with a supplier in order to disclose what those funds are going to be used for in future years. If, as Tyler says, you've simply ring fenced the monies, you've minuted the discussion in a relevant meeting, then you can of course disclose that fact within your trustees report, within the accounts which is submitted at the end of the year. And I always say actually to trusts that at the end of the calendar year, your only form of communication with the ESFA is through your trustees report. So please put in there any information you can about any funds that are being ring fenced, and then you really get rid of that problem or question about clawbacks if you've answered that question before they come to you. We then get on to RAC, which of course is another hot topic in the sector at the moment, and also good estates management for schools, which of course goes alongside that. It was announced this morning, as I'm sure a lot of you will be aware, that there are yet more schools that have now come under the RAC problem. And we were actually at a conference a few weeks ago where they said that of the 24,400 schools in England, it would take, of course, 488 years to rebuild every school. But how many school buildings do we know that are 488 years old? In fact, how many recently built school buildings do we know were designed to last more than 75 years. So really, this is the problem that we don't really have an answer on at the moment, but it's just a topic that we're hoping to get some more guidance on.
And it's something I've been thinking about myself as a trustee of a trust that builds new schools. You know, we specialise in building and opening new provision, and we've got a school that's 2 years old and the roof is falling in. Well, if that doesn't say that these buildings are not built to last, then I don't know what does. It's very concerning. I mean, we can't rebuild all these schools, so something really does need to be done.
The question I know that will be posed a lot in our meetings with our audit clients now going into the audit season is actually what disclosure is going to be put into the accounts of the impacted trusts. We're speaking to the Institute at the moment about exactly what disclosure will or should be put into the accounts, but I'd like to see that at least a post-balance sheet event is going to be added to our impacted trusts this year. Just merely to give the users of the accounts a little bit more detail about the current situation and hopefully what might be happening in the near future as well.
Great, so now we're going to just have a bit of a look at the sector in general and kind of have a look at some lovely graphics we've got that kind of show what's kind of going on. So you would think throughout all of this and the white paper, which Carly will come back to in a bit, that we would be on where most schools are academy trusts. It is very much not the case. As you can see in these graphs, we've still got 52.6% of all schools that are local authority. And that is a very large number of the 42,000 schools, 24,000 schools, sorry. You know, over 12,000 are still maintained. So that's a significant number. Now, it's interesting to see, actually, when you break that from primary to secondary, how the split really changes. Actually, on primary schools, nearly 60% are still local authority versus secondaries where over 80% are now academies. And actually, that's been the case for some years. And then we can see here about the sizes of mats. Now, actually, this is really interesting because the sector's been trending towards larger mats for some years, as we kind of know. And these graphs kind of start to show it. Actually, the graph headed with the January 23, you can see that now we've got nearly 21% of academies fall into trusts with 21 plus academies in them. So what we would call large trusts. Which is an impressive move, considering when you look at the small table at the bottom, back in December 2018, we only had 3% of all academies in those large trusts. And actually, you can see the big movers there really is from the small trusts, your 1 to 5s, moving from 69% in December 2018 to 32% in January 23. And also your large trusts massively increasing. And that's significant as well. You can see from the other graph on the right-hand side that actually the single academy trusts are decreasing also, down from 20% in December 2018 down to 12.1% in January 23. And then we've got it's also interesting to have a look at the Department for Education's assurance work. So every year they do some work based on the regularity reports, of which ourselves and other auditors submit to them, and they like to have a look at the modifications. And this really shows the hot topics for the sector. You know, what's going on, what are people really concerned about at the moment? And you can see actually at the top, as we'll kind of come back to a little bit in the ATH, is actually financial management and reporting. That was a huge number of modifications last year and the year before on the issues that auditors are having. Related party transactions are also really high up there and kind of always have been. And then kind of as you filter down, the classics like alcohol and fraud and theft also crop up. Also, you can see the large outlier of COVID-19.
Of course, the point about movements from SATs to MATs and from local authority schools into an academy trust of some sort is all supported by the white paper, which was released first of all in March 22. And the strategic objective, when it was first released, said that by 2030, all children will be taught in a school, in a strong trust, or with plans to join or form one. However, as we all know, the idea behind the white paper and the strategic objective of the DfE has now slightly changed, and they've now stated that if we get this right, we will see the vast majority of schools in trust before 2030. So that's the key difference between early 2022 and where the white paper really is now. To support this, the white paper was made up of, or is made up of, 5 pillars of what a quality trust should look like. So you can see on the screen there what the new 5 pillars are. And those 5 pillars were actually amended to what you can see on the screen in July 2023 from feedback that the ESFA received regarding the importance of other centralised functions like HR and estates management, and therefore to be clear about the role of executive as well as non-executive leadership within trust. So number 4 actually used to be just financial management. And number 5 used to be just strategic governance, and you can see how they've now changed to finance and operation, and the 5th being governance and leadership. So that's really the change in strategy. They want all schools to become a part of strong trusts, but it's not going to be a must, more a movement towards now by 2030.
Obviously, it's probably worth mentioning at this point, there is an election looming within the next few years, and that may change things yet again. And at the moment, you can see from this quote that actually ministers and various representatives of government bodies are very much backing up this white paper and this whole get everyone into a strong multi-academy trust from this quote here on the 9th of February this year.
We now come on to the main key point of this webinar, being the Academy Trust handbook, and the updates to the ATH 2023. So, of course, the first point really to note is, when do the changes in the ATH 2023 apply? And of course, they come into effect from the 1st of September 2023. So this won't be relevant for your audits for the year ended 31st of August 23, but is now relevant, or are relevant, for the academic year that we are now in. The first point is the related parties point, and the changes made to the related party transactions point within the ATH. You can see there the first bullet point talks about the commencement and renewal of contracts. Trusts must now report the commencement and renewal of contracts with related parties to the ESFA. Previously, this was just on commencement of contracts, not renewal, so that's a key point to just take into account. The second one, I think everyone knows this one by now, is of course the threshold has increased and actually simplified. So it used to be a £20,000 aggregate threshold, whereas now it's become a £40,000 threshold. So the requirements to consider related party transactions were on an aggregate basis, and that's now been removed. And as such, reporting to the ESFA only now needs to be considered on the value of each transaction above £40,000. So you can see that's actually going into the third bullet point down about the aggregate requirements. There's also a point about the exemptions to approve related party transactions. So there was a point that discussed the idea that subsidiaries of academy trusts need to have approval for related party transactions, but now providing goods and services to any college, university or school from sponsors of trusts and any state-funded schools or colleges, that doesn't need approval in terms of their transactions. Also exempt is the provision of services to an academy trust with a religious character by their religious authority, where they are essential and can only be provided by their religious authority. So that's really coming under the additional exemptions now. Again, just simplifying the point about when you need to get approval for related party transactions. In terms of roles and responsibilities, the key point here is staff trustees are no longer allowed to be employees of the trust. So they said less obviously in the text of the ATH, that the employees must not serve as trustees other than the senior executive leader. Merely in the ATH 2022, there was just a strong preference for this. Just going down to the next bullet point, accounting officer and the CFO must also not be the same person. I think that's widely accepted in the sector now, and most trusts are aware of this point, but you still have the odd trust where they have this problem, and this is a should, not a must, but a should, that they should not be the same person. So trusts still in that boat should really take heed and think about what they're going to do and put those plans in place as soon as possible. Then we get on to the financial challenge at trustees' meetings. So the ATH confirms that the board should have sufficient knowledge to hold the executive to account. And there was a minor change in the wording that just reinforces the need for strong financial knowledge at the trustee level. When management packs were introduced a few years ago, and the idea that management packs were going to be circulated at least 6 times a year to the board, that was really when the sector realised, or it was confirmed to the sector, that really the board should have sufficient financial knowledge to understand those management packs. But now it's really putting into black and white that sufficient financial knowledge does really need to be at the board level, which I'm sure you'd expect anyway, and to have enough financial knowledge to challenge and raise pertinent questions at relevant trustees' meetings. Of course, the other point that we wanted to bring up in terms of the Academy Trust Handbook is good estates management, or GENS, good estates management for schools. But of course, that now incorporates RAC, given that's now become a key point in the news lately. Really, the only thing I wanted to say about this is that, as trusts are aware, they'll have to report on their GENS, good estates management for schools, and how they are faring on good estates management at their trust within both the regularity report but also in the governance statement for the accounts that are submitted to the SFA by the end of December this year. One thing that's really come to mind recently, particularly in light of RAC, is that you might want to put in, if it's relevant to your trust, the fact that actually you're only achieving good estates management so far as funding permits, really relaying that message to the SFA as much as you can, that you can't tick all the boxes perhaps because the funding really isn't there at the moment.
Now, naturally, as RAC is such a new thing, we are completely in the dark as to what potential funding might come out of this, if there's any. Everyone hopes there is, or kind of what guidance they're going to give us. It's very slim on the ground at the moment. We're hoping within the kind of next coming months or so that they will give us some guidance, potentially offer some extra money up to support those schools that have this RAC issue. Remains to be seen. We'll obviously update you when it comes. In the meantime, trusts could start to think about what's called UCS, or urgent capital support. Kind of comes in if you can claim SIF funding, and essentially it's money there for, as it says on the tin, really urgent capital projects, of which, to be fair, RAC probably falls under, i.e. it's significant structural issues that you might be able to get some funding for there. The only thing to note with that is currently that comes majoritively in the portion of a loan. I think most people will be hoping that some RAC money comes up that's not a loan, but that remains to be seen. But anyway, that's something that you could look to explore if helpful. Also, with this good estates management, they've kind of beefed up the handbook quite a lot with some extra publications and lots of links to other Department for Education kind of guidance on how to do good estates management, and the risks, and lots of exciting other publications, of which, if you really want to read into, you can.
The other smaller points that the ATH covers now is the fact that, of course, the budget forecast return, the deadline changed, as you all know, this year to the end of August. And of course, the AAR deadline is now going to be the 30th of January 2024, which of course will help the timeline just after the audit season's finished. There is also a point about simplifying the position on the preparation and circulation of the management accounts, including more discretion for trusts. So the point I mentioned before about management accounts being shared with trustees 6 times a year has actually been removed, allowing them to be considered just at each board meeting. The chair must, of course, continue to receive these monthly. They've also clarified the circumstances in which an NTI might be issued, and they've now provided examples in the ATH regarding the reasons for issuing an NTI. We've noted there about electric vehicle salary sacrifice, just to clarify the point that there's actually no need for approval from the ESFA if no liability falls on the trust. Should, of course, a liability or any liability fall on the trust, or the trust is under an NTI, then of course prior ESFA approval must be sought. Then just a small point on the governance statement, that the ATH now confirms that trusts no longer need to provide an explanation in their governance statement where the board has not met at least 6 times in the year. So really, generally, it feels that they're giving more discretion to trusts while stating explicitly the key points that may have not been stated previously.
And we can see this really backed up by Baroness Barron, who is one of the ministers for education, and she's quoted as referring to the ATH as simpler, shorter and more sharply focused. And this really clarifies and sums up everything they've done to the Academy Trust Handbook this year. They've significantly cut it down. You know, they've removed at least 20 pages from it. It's much shorter, it's much more precise, and they've tried as much as they can to remove some of the kind of fluffy, wordy, ambiguous elements and make it more precise and to the point, and less open for interpretation. So they've been working on that quite heavily this year, and you can see the ATH 23 looks quite different. And I think, you know, we're hearing certainly from the Department for Education that they're going to continue doing this next year for 24, and it looks like they're going to be continuing to sharpen this up and just make it as concise and to the point as they really can do. So moving on then to the Academy Accounts Direction, frankly, there's very little in terms of changes that were particularly exciting, but they've made a few kind of clarifications. So to start with, we've got this school building safety risk, and that's about, you know, talking about that in the governance statement and the trustees report, isn't it? So, you know, they've kind of clarified the kind of wording you should be putting into the trustees report and how you should be explaining the risks and all of that real excitement. Your material income streams, that's about your note 4, where previously we might have been putting a lot of the income into what would be the other line for kind of DFE, ESFA income. They very much said if it's a material income stream, then it needs to be split out. So we started to see things like pupil premium being split out in the past. You know, we would possibly now start to see other things like nursery funding being split out, PE and sports grant being split out, you know, more of the individual streams that are not wrapped up into the national funding formula, they would like to see kind of split out. So that kind of clarified that. Then you've got the concessionary loans, and that's, you know, very much on the same. As you know, no loans are really allowed in terms of, as far as academies are concerned. What they've kind of gone with here is they're just kind of clarifying about the wording and information that needs to be in there. And, you know, essentially for things like SALEX and those other kind of non-loan loans, essentially. And concessionary loans are all about where it's kind of lower interest loans for the purposes of kind of quote unquote doing education. That they've kind of clarified some points on that. Teaching assistants very much stated that they are support staff rather than teaching staff. So when you are doing The staff costs note, previously there was some possible sway between it being put in teaching staff or support staff. This is very much clarified as they are support staff now, and they will go in support staff. So that is good clarification for the sector as a whole, so everyone is on the same page. That is great.
I think that's really a point for the material income streams, but also the teaching assistants point as well, that now hopefully a lot of trusts, or the majority of trusts, will be accounting or disclosing their material income streams and also their staff costs in the same place across all their accounts. So they're going to be much more comparable. You're not comparing apples with pears between different sets of trust accounts, and therefore there'll be benchmarking that will be made a lot easier across the sector.
Absolutely, that's the entire plan, I think, isn't it? So they can get it to the same place. That's the hope. Lastly is the LGPS liability. As we know, this has been a bit up and down in the last couple of years with inflation kind of going all over the place, and some people have seen them massively reduce. Regardless, it's just a confirmation really from the DFE there that, you know, they will continue to kind of guarantee that, and that's not going to be something that comes out of the Academies kind of reserves to fund or anything like that. So it's just that the guarantee is still very much in place. Anything to add on account structuring, Carly?
I don't think so. I think there's, as you said right at the beginning, there's only really clarification. I think for me, the clarification of the second and the fourth point there on our slide is very helpful. For disclosure purposes, comparing trusts, particularly as an auditor looking at over 50 trusts myself and trust accounts myself, I want to see some consistency. Of course, there's going to be elements where the trust can use their discretion about an extra disclosure note or what might or might not be in a certain note, but on the majority of points, I like to see consistency, and this is really confirming that there will be some consistency this year more than before.
Absolutely.
I think there is some extra wording required in the governance statement and trustees report around estates management and health and safety, and I think that we as a firm are going to recommend that our clients add in some extra wording around that sort of talks about to the best of our funding ability, just to cover trustees and governors in relation to that. So it's something that we will discuss when the accounts are being prepared and finalised, but it's definitely some new wording that is required, and so we will cover that and ensure that trustees and governors are suitably covered.
Great point, thank you, Jake. So this is an interesting point and quote that was made to us on a conference recently by the ISBL National Lead on School Finance, who happens to be the Director of Finance at Southend School for Boys, called Simon Oxenham. Now, he said that his curriculum lives in the shadow of finance and that his £2.2 million deficit is the new normal. And I think that's very striking. I think that really shows how much and the kind of state of academy finance is in at the moment, and how, you know, kind of short funded we are being, and how this is really, you know, we're not getting the funding we are hoping for to kind of do the curriculum that we want to, and very much the curriculum is being almost curtailed by the money we are getting, and we're just kind of having to do whatever we can given the money we have. And the fact that he's saying he's got a huge deficit, I don't think that's anything but normal for most of us now. You know, I think it really hits home to me just exactly what's kind of going on in the funding through the sector.
Thanks, guys.
So just a little bit about how we can help you. So kind of key point for me, and Carly's going to talk about some of the others, is trustee training. Now, we kind of spoke about how it's really important for, as mentioned in the ATH, how it's really important for trustees to understand and perform good financial management and challenge at their trustee meetings. Now, something we could provide, and we have done many times in the past, is providing some training to the trustees of what to look at their trustees meetings, the kind of questions to ask, how to read management accounts, simple things like this, of which actually will allow them to more effectively ask questions about the information they're receiving and really understand the information they're receiving, so they don't kind of feel they're entirely in the dark about, you know, this lovely set of management accounts of which, you know, this finance director has produced for them, but they understand nothing of. So very much something we can perform and help you with is some trustee training, and that's either via, you know, a Zoom session or in person, or we can come along to one of your trustee meetings and we can provide some training to your trustees on kind of what to look at financially. And I think Carly's going to talk about internal scrutiny as well.
Can I just touch on that? I think it's really important because obviously trusts, the makeup of a board of trustees should have a mixed skill set. So there will be people who have certain skill sets that maybe are not financially literate, and they are being asked as trustees to sign off on a set of financial statements at the end of the year that they have approved, and often this is delegated to the finance committee, which is fine. But in reality, these trustees should understand or have a basic understanding of finance and accounting. And look, we've, as Tyler mentioned, we've offered it to a number of our clients, and I really think it is very useful for them. And I think it's really important that trustees have a basic understanding, at least financially, of what the management accounts and financial statements are showing.
Just on a side point to that, as some of you may know, we also run a conference around the March time each year, focusing really on trustees' responsibilities. So it's not quite trustee training, but it lightly covers trustees' responsibilities, changes in perhaps that year, and we usually have a speaker from the National Government Association, the NGA, that comes to speak about those responsibilities. That's very useful too. Just one point I actually wanted to speak about on this slide is internal scrutiny. As you'll all know, the ATH says we must have an internal scrutiny report at each A&R meeting. We must deliver an internal scrutiny throughout the year, and we must have an annual programme of internal scrutiny, and there should be termly meetings on internal scrutiny. I do feel that the subject matters or focus areas have changed somewhat since internal scrutiny was introduced a few years ago. When it was first introduced, I was speaking to trusts quite a lot about just financial areas that they might want to focus on. That was really the idea at the time when internal scrutiny really came into play and replaced RO visits, responsible officer visits. Now, actually, the trend, quite rightly, is going into broader focal areas. So we see a lot of trusts looking at sustainability, ICT standards, including cybersecurity, ICFP, how the trust can use ICFP to create the best curriculum for their pupils with their available funding, health and safety, good estates management, GEMS. Of course, that's going to probably become more of a popular focus point now with RAC coming into play as well. And then also their recruitment process too. And we can really help with any of those areas at BKL. So it's not just financial areas we can look at. So please have a discussion with us if you're thinking about a broader focus point or areas to look at.
Can I just say, I think the key point here as well is that the risk register should be what you guys are using to base the internal scrutiny work that is being carried out on an annual basis. So that risk register is an incredibly important document that trusts should be using on an ongoing basis and revisiting on an ongoing basis. I know there are often situations where trusts create a risk register when they're incorporated or potentially on an annual basis. It's an enormous document and it's not really very easy to comprehend or to use as an effective tool. And the reality is the internal scrutiny work should be looking at ways of mitigating risk and main risks that are associated with the trust that you as trusts have control of. So it's really an important document that should be discussed at least termly, in my opinion. And that's where the body of internal scrutiny work should come from.
And a good point, actually, just from Jake's point, is if you are in a larger trust, you may actually want to have a sub-risk register to assist local leadership. So you may have a central risk register, and as Jake has alluded to, make a concise central risk register that's updated at key points during the year, or at least once a year, and then perhaps have a sub-risk register that's relevant to the local academy within the trust. That's a good point just to think about if you're in a larger trust. The other points we make there are quite self-explanatory, so I won't go into anything too much, but really we can help in all these areas and to add value. So you can see we help with, of course, Annex G audits, due diligence if you're thinking of taking in other schools that are going to convert to academies, or SATs, or even an academy from another MAT coming into your trust, so due diligence on all those options, VAT and tax advice, including on setting up possibly a trading subsidiary in relevant cases, and that goes on to the second to last point, and of course budget forecasting as well, which comes back to the point about the threshold of 20% that the ESFA spoke about first of all last year in regards to reserves being held at the year end as a percentage of annual revenue income, and keeping that in mind when you're budget forecasting.
Thank you, guys. So we will now go to some questions that we've received via email actually prior to the webinar. There don't appear to be any in the Q&A box. If you do have any, then please do drop them in there. The first question looks at this teachers' pay increase and the unfunded element. Can you elaborate on the unfunded element of the teachers' pay increase, please, if that's okay?
We spoke about right at the beginning about the teacher pay rise. As I said, 6.5% was the total rise, and then of course the unfunded element, which this question is asking about, is 3.5%. Actually, what I might bring in is the example we heard about at a sector update a few weeks ago, in which if you look at the KPI staff costs as a percentage of revenue grant income, which for me I think is a very key KPI, and the ESFA say that the optimal level for a trust at this KPI is around the 80% mark. Average is about 84%. Of course, there are elements that are going to skew this benchmark, which I won't go into now. But if you take that KPI and you look at an example, School A is at 75% of that benchmark. So a 2% unfunded pay rise requires an 8% reduction in the non-pay budget. Whereas actually if you had School B, which is at an average of 84%, that 2% unfunded pay rise would require a 12.5% reduction in non-pay budget. And what happens actually to a trust which is below average? We see all the time trusts that are really nearing the 90% mark, 87%, 90%. So unfortunately I don't really have an answer, but really just to point out the problem here, that an average trust on that KPI is going to have a serious problem, and what happens when they are indeed below average.
Also, that trusts are going to be expected to operate within their funding, and so that is unfortunately a cost that schools are going to have to bear and work within their budgets going forward. Okay, thank you for that. The next question's about staff trustees, which obviously you touched on. We as a trust have staff trustees at the moment. What do we need to be doing in relation to this, and are we breaching the ATH at the moment?
Well, I think it's a really interesting question, and I think to answer it almost straight off, and then I'll explain a bit. Broadly, no, you're not breaching the ATH. I think that's very, very straight to say. The ATH this year is ambiguous about how it puts staff trustees. It does not state that you must not have staff trustees. However, it is, I would say, a hair slivers away from stating that. It is almost stating that, I would say. Last year it was a strong preference. This year it's saying they should not. I would take that very much as read, pretty much don't do it. So are you breaching the ATH? No. Would I look at moving towards getting, removing the staff trustees? Yes. How you go about that? Well, almost in any other way as a trustee resigning. So naturally, have a conversation about it at your next trustees meeting, and very much set some plans in place, discuss with the trustees or staff members that are going to be, resigning, and naturally put that in place. The other thing to also check is actually the kind of constitution or governing document of the Academy Trust, especially the older and longer established Academy Trust documents where the kind of constitutional governing document hasn't been changed. The original governing document might actually state a requirement to have staff trustees, of which is now in odds with the ATH. And that very much just shows how much the ATH has changed from back in 2010. But essentially I would have a look at your governing document and check that that's not prescribing that you have some staff trustees. If it does, then you probably need to speak to some kind of legal representation to look at trying to update that to the latest kind of model, and then almost just follow the resignation process through as normal.
I think the point also is that even though it's still a should in the ATH, and the wording is therefore still vague, I do feel that the wording is stronger than it was before, and therefore trusts really do need to take this point seriously and do something about it when you can.
I could see it going to a must very quickly.
Okay, perfect. The next question is about, I guess, the national funding formula. There were teachers' pay and teachers' pension grants that were given previously when there were previous pay rises and increases in pension contributions that were funded by the government, and then they moved into the national funding formula. Do you expect the same thing to happen with the mainstream schools additional grant, or will it be a separate grant going forwards?
So the NSAG will be part of the national funding formula for 24-25. It wasn't, of course, for 23-24, so that's a big change for the NSAG. As the question, I think, implies, this happens for a lot of new grants. I feel that they make good headlines in that first year, and then it's brought into the national funding formula. But of course, that helps the trust in the fact there's less complexity in terms of the monies that trusts are receiving. So it's not all bad being in the national funding formula. However, I must state actually that when you review your accounts after your audit this year, going into next year, you must be careful when you know that grants have been incorporated this year into the national funding formula, whereas previously they were received separately, because of course, as I said before on another point, you will be comparing prior year to current year, apples with pears to some extent, because you will classify that revenue stream separately last year, whereas it will be part of the national funding formula this year, and that's exactly what's happened with the NSAG.
My fear with grants being wrapped up in the national funding formula is that over time the SFA managed to reduce that funding, or the government. So yes, there may be 1.5 billion that's come in this year. Over time, I imagine that will decrease. The government have got their good PR, I guess, from putting more money into the sector. So that's my fear with grants being wrapped up in the national funding formula. So yes, your income or your national funding formula income will increase, but will it increase over time in line with the increases in the grant if it were kept separate? The final point, or the final question that we have, is what are BKL doing for trusts that need help with SCCR reporting requirements?
So we're partnering with another company now which specialise in this type of reporting. As I'm sure you'll all be aware of, trusts or schools that meet two of the relevant conditions, which are broadly 250 employees or more, turnover of £36 million or more, and or balance sheet assets of £18 million or more, must have SCCR reporting or do SCCR reporting as part of their annual accounts. But of course, you then have smaller MATs or individual schools that are now choosing to record their energy consumption and carbon emission levels as part of their trustees report within their accounts at the end of the year. So please do get in touch if you want to have some help in regards to SCCR reporting. We've got, as I say, a specialist that we've partnered with now in that area.
Thank you very much. Perfect. Okay, so that concludes the webinar. We will be doing these now on a regular basis, and if you have any questions for us going forward, then please contact us either via email or alternatively through the contact form on the website. There will be a recording of this webinar on our website, and it will actually be emailed across to all of you along with the slides from the webinar. We hope you found this useful, and we look forward to seeing you all soon. Thank you very much.